All this panic about war, it's a distraction. While everyone is glued to war headlines, they're missing the shifts that will decide who wins and loses financially over the next decade. We're conditioned to fear the thunder of the cannon, but history shows that the market's first reaction to war is almost always an overreaction. So what if the biggest risks to your portfolio aren't the ones you see on the news? Let's be clear. War is a human tragedy, and it feels like it should carry an equally immense financial cost. When a conflict erupts, the market's response is a textbook case of fear. On the day Russia invaded Ukraine, European markets plunged. When US markets reopened after 9/11, the Dow dropped over 7%. This is the market's knee-jerk reflex. The mechanism is simple. Trading algorithms, programmed to react to keywords, start selling. Human traders, driven by a primal need to avoid loss, follow suit. They dump risky assets like stocks and flee to safe havens like gold or government bonds. The market isn't making a sophisticated analysis. It's reacting to the possibility of a worst-case scenario. But what happens next is the part most people miss. Just 1 month after the invasion of Ukraine, the S&P 500 had already recovered its initial losses. In the months following 9/11, the market bounced back as the initial shock wore off. The pattern is clear. Markets panic over the event, but then, almost as quickly, they move on. This creates a dangerous illusion. It teaches us to watch the headlines, brace for a quick dip, and then buy the recovery. But this focus on the visible, short-term crisis sucks up all our attention, while truly transformative risks are evolving in plain sight, completely ignored. What actually matters more? While the market is busy reacting to the noise, the fundamental architecture of the global economy is being permanently rewired. These aren't loud events. They are quiet, grinding processes. They don't fit into a news cycle, but their impact will be vastly more significant. Let's focus on the two that matter most. Shift 1. The Great Rewiring of the Global Economy. For the last 40 years, the global economy ran on one idea: make things wherever it's cheapest. This created hyper-efficient supply chains, but it also made them incredibly fragile. That era is over. We are now in the middle of a great rewiring, a historic shift from just-in-time to just-in-case. It's not happening because of one war. It's because of a decade of accumulated risk, from the pandemic to geopolitical tensions. Companies are realizing that chasing the lowest cost isn't worth it if your entire supply chain can be paralyzed overnight. So they are rewiring the plumbing of the global economy. They're moving production closer to home, a process called nearshoring. They're relocating to allied nations, or friend-shoring. They are building self-contained, regional supply chains. This is why you're seeing factories move to Mexico, semiconductor plants built in Arizona, and companies willingly paying more just to reduce geopolitical risk. The market completely misprices this. Why? Because there's no regionalization day headline. It's a million quiet decisions made in boardrooms. But the long-term consequences are profound. This rewiring means permanently higher costs. It means a new baseline for inflation, unlike the era of hyperglobalization that pushed prices down for decades. While the market panics about a temporary spike in oil, it ignores the permanent increase in the base cost of almost every physical good in the world. That's not an event, it's a new reality. The second ignored reality is that we are moving into a world where economics is a weapon. The era of ever-expanding free trade is fracturing. Countries are now using tariffs, export controls, and strategic investments as tools of national security. The world is splitting into distinct economic blocs, one centered around the US and its allies, another around China and its partners. This is what some call geopolitical fragmentation. It's not a temporary trade spat. It's a deep stress fracture in the global order. Success for a global company may now depend as much on its passport as its product. The Organization for Economic Cooperation and Development has warned that this kind of fragmentation could significantly reduce global GDP. But how do you put a price on the slow erosion of trust between nations? You can't. There's no single event to react to, and this brings us to the single most important idea in this video. Markets are built to overreact to events, but they chronically underreact to patterns. A war is an event. It's loud, dramatic, and has a clear beginning. The rewiring of supply chains is a pattern. It's quiet, complex, and unfolds over years. A sanction is an event. The world splitting into competing economic blocks is a pattern. Your job as an investor is to do the opposite of what the market does. Ignore the events and focus on the patterns. The first order effect of a conflict is a market dip. The second order effect is a company deciding to build a factory in Mexico instead of China. The third order effect is a permanent shift in the economic balance of power. The real advantage comes from positioning for the world that is coming, not the one that is. If you're more interested in understanding these long-term patterns than reacting to short-term noise, then subscribe to this channel. We don't chase headlines. We analyze the underlying shifts that truly matter. In our next video, we'll dive deeper and map out the world's most critical supply chain choke points, the specific canals, straits, and hubs where one small disruption could trigger a global crisis. So I'll leave you with a question. Are you investing for the headlines of today or the patterns of tomorrow? Once you see these patterns, you can't unsee them, and they completely change how you think about commodities, industrials, and even long-term asset allocation. Thanks for watching.